Let's take a look now at 2017 from the perspective of an alternative investment market investor. The AIM market is very well received in some quarters, but others think it's a place to avoid. Let's now get an idea now from Chris Boxall, who runs the AIM portfolio fund at Fundamental Asset Management. Chris, welcome.
Hello.
Now, of course, you've got an AIM portfolio, so you're going to be saying things are going to be good. But how do you feel about 2017?
Well, pretty good at the moment. I shouldn't say that probably, but it's interesting. I think AIM's changed so much over the 12 years that we've been investing it for inheritance tax planning purposes. I mean, we focus on the investment attractions. It just so happens it comes with a terrific inheritance tax planning kicker as well. But the market has changed. It just changed massively. It's dropped from 1,700 companies to just under 1,000. But so the remaining business are much, much stronger. Average market caps over sort of 80 million when it was a fraction of that a few years ago. So overall, it's looking very strong. Some very nice businesses that are growing earnings and cash at double-digit levels and are not as heavily indebted as they used to be. So it's looking very, very encouraging.
Do you see as an appetite growing for some of the smaller FTSE 350 companies, for example, to become AIM listed? I mean, we've got a massive multi-billion pound company already on AIM, haven't we? ASOS, for example. I mean, that grew out of nothing, but it stayed on AIM for reasons doubtless you will endorse.
Yeah, well, I think there's a good, as I mentioned before, there's a growing attraction from an inheritance tax planning perspective. So if you've got a big stake in an AIM company or you've got family holdings in an AIM company, they remain outside of your estate for inheritance tax planning. In a low interest rate environment, what do? You flog out and you've got a heap of cash. Where do you put it? And you've suddenly shoved all that money into the IHT net. So you can go on owning a reasonable stake in a nice business, collecting dividends, so it's paying you. And that is, to me, a no-brainer kind of attraction for sticking around in a listed business.
What about funding for some of these smaller AIM-listed companies? How is that changing? Because banks are becoming far more reluctant to lend in some circumstances.
They are, or I sense though from a lot of our AIM stocks they're opening up. What I do see for AIM, as I was saying, the market is now composed of much stronger businesses. A few years ago, a lot of earlier stage businesses used to raise new money for AIM. I see the crowdfunders taking over from where AIM was in terms of those very small businesses, and crowdfunding sites have raised quite sizable sums recently, I've noticed. So that's going on in the micro cap space, which means that those companies coming to AIM are much stronger. You're seeing partial founder exits in addition to new money being raised. It's not great for the corporate brokers because they're probably not seeing the flow they were used to. And I do, we need the corporate brokers to be strong. We need them to develop their operations, but it isn't easy for them, I can see.
One of the things as a fund manager you have to deal with sometimes is when funds were taken out of your fund because they've been taken over. I know you've had this, haven't you, at the back end of 2016.
Yeah, it makes me tear my hair out.
I mean, that's the thing is about AIM, isn't it? You do get this churn, don't you, for stocks leaving because of takeovers.
I mean, UK's for sale, post-Brexit. I mean, we've sold out to the rest of the world anyway. Our currency's in the toilet, and everybody's looking at these high growth businesses, some of which are trading at very low multiples. You compare that to the US market, even in the micro cap space, and it's night and day. So you can see why a lot of AIM is up for sale. And I can see more and more takeover activity over the coming year, which I find disappointing. I like to stick with these businesses. I hate them taken, especially good ones that are doing so nicely. I hate them taken from my grasp at such an early stage.
Well, you mentioned the FX markets and the impact on some of these deals where foreign takeovers. What about other companies that operate within the AIM space? Are they massively exposed to the foreign exchange movements that we've seen?
Many of them, a lot of people, I got very frustrated. A lot of people making a big issue about FX, and most of our companies have demonstrated those that are exposed negatively to FX, that they can manage out of it. They batten down the hatches, adapt a bit. We've mentioned Character Group before. It's got big FX exposure, but it's been doing very nicely. It's just delivered pretty robust results and is looking very positive. Others have benefited positively from the FX and may continue to do. But it's very temporary, this FX. People get hung up with it. If you've got a good business with good products, this FX benefit or headwind is only going to be temporary. So you've got to look longer term and in my opinion, dismiss the short-term FX.
Longer term as well, we're now being told possibly to expect interest rate rises. How is this going to impact on the AIM space, do you think?
Thankfully, a lot of our stocks have got pretty robust balance sheets. They haven't got that much debt, so it's not going to impact them really one way or the other. They might get, those that are carrying cash might get a bit of a benefit. But I mean, where have interest got to move to? We've got a point here, a point there, until we get to a meaningful level that could start impacting things. I mean, it's been so supportive for the last few years. It's about time maybe we had something to rein things back a little bit. But yeah, we don't see meaningful impact from interest rate in the short term.
So AIM remains the place to be so far as you're concerned?
I wish over the last, I mean, we managed money in blue chip portfolios, balanced portfolios. Quite frankly, I wish I'd only invested in AIM over the last 12 years. I mean, the returns have knocked the lights out compared to everything. You've got to bear in mind that occasionally you get a little bit more volatility. You've got to sit back, ride it out. There's a lot of irrational exuberance, and over the long term, with patience, it can deliver handsomely.
And of course, you get over bumps in the road like Brexit, which is something else that potentially could well be triggered next year.
Brexit, everybody, what you do have in AIM occasionally in this illiquidity crisis, because many of these stocks aren't that liquid. So post-Brexit, everybody starts panicking. When you start panicking with an illiquid stock and say, I'm out, I'm so worried, what's going to happen over the next few years, the price can tumble very, very rapidly. And that's like a snowball. That's when there are opportunities.
Do you carry much money in your fund? Cash?
As we are largely investing, as our biggest chunk of our AIM money is for inheritance tax planning, we are obliged to be fully invested. So we never have the cushion or not to have too much cash. So if our stocks are subject to takeovers, we have to reinvest that quite quickly. On our other books, yes, we run a lot higher balance of cash, so we have got stuff to deploy when necessary. Okay, well, look, good luck for 2017. Thanks very much.
Come back in, Chris. Thanks indeed for joining us. Chris Boxall, there is the fund manager at Fundamental Asset Management, where he oversees the performance of his AIM portfolio fund.